Welcome. Today, we're going to dive into the world of inflation and deflation, two concepts that can significantly impact your purchasing power and financial goals. So, let's get started. Inflation is the rate at which the general level of prices for goods and services is rising, and the purchasing power of currency is decreasing. This means that over time, you may need to spend more money to purchase the same goods and services. Inflation is influenced by a range of factors, including supply and demand, government policies, and global events. It's typically measured using an inflation rate, which is the percentage increase in prices over a specific period, such as a year. Let's take an example. If you have $10 now and inflation is 2%, you might need $10.2 next year to buy the same things you could buy for $10 this year. While inflation and deflation are opposite phenomena, inflation can erode your purchasing power over time, making it more expensive to maintain your standard. While deflation, on the other hand, can make it harder for businesses to make a profit, leading to job losses and economic instability. It's important to understand how inflation and deflation work and how they can affect your financial goals. Let's take an example. If you have $10 now and deflation is 2%, you might only need $9.8 next year to buy the same things you could buy for $10 this year. For a better understanding, let's illustrate the concepts of inflation and deflation. Let's look at a practical example. Imagine you have $100 in your savings account, and the inflation rate is 2%. After 1 year, your $100 will only have a purchasing power of $98 due to the increase in prices. On the other hand, if the inflation rate is -2%, your $100 will have a purchasing power of $102 after 1 year. Now that we understand the basics of inflation, let's talk about some practical tips to help you manage its impact on your finances. Invest in assets that tend to appreciate over time, such as real estate or stocks. Adjust your spending habits, such as buying in bulk or purchasing goods and services during off-peak times. Consider investing in inflation-protected securities. Increase your income to keep up with rising prices. By taking these steps, you can help protect your finances from the effects of inflation and ensure that your money continues to work for you. While inflation is something that many people worry about, deflation can also have a significant impact on your finances. Here are some practical tips to help you manage its effects. Focus on paying off debt and reducing your expenses. Consider investing in long-term bonds and other fixed-income securities. Take advantage of lower prices by buying assets that will appreciate over time. Increase your savings to prepare for potential future economic downturns. Consider taking on additional work or finding new sources of income. By following these tips, you can help protect your finances from the impact of deflation and prepare yourself for potential economic downturns. In summary, inflation and deflation are important concepts to understand when it comes to managing your finances. Inflation refers to the rate at which the general level of prices for goods and services is rising, and deflation refers to the opposite. Both can have significant impacts on your financial goals and purchasing power, so it's important to stay informed and take steps to manage them. That's it for today's episode. Don't forget to subscribe to our channel and hit the notification bell to stay updated on our latest content. Join us next week as we explore the impact of recessions and depressions on the economy. Thanks for tuning in, and we'll see you next time.